wanted to go back to a point you had made that there really is nothing new here. Maybe talk a little bit about quantitative easing, one of those new things that QE really isn't actually all that new. And maybe actually could describe for our listeners what quantitative easing is a little bit also.
Oh, okay. So let's delve into that. I'm not big on talking about monetary stuff, but I've been studying this stuff for 40 years, so I get it. Quantitative easing is nothing more than the Federal Reserve going out and buying bonds in the open market. Well, just so you know, there is an open market desk at the Fed, and it's been there, I think, since the 1920s. So them buying bonds in the open market is not unusual. What's unusual with QE is the quantity, and the type of thing that they're buying. Generally, when they're trying to affect policy, if they're trying to affect interest rates, they will buy or sell treasury bills. But quantitative easing will have them going out and buying longer-term bonds. We have done quantitative easing in the past. This is not new. We did it after during and after World War II. There was an agreement between the Treasury and the Fed that they would maintain that the Fed was essentially going to peg interest rates, yield curve control, if you want to call it that. That's what the popular term is these days, where the 10-year was pegged at a certain rate, the 5-year was at a certain. Actually, I don't know. They have a 10-year. I guess they had a 10-year. They didn't have a 30-year. 10-year, 5-year, 2 years, in bills or whatever. But they pegged the whole yield curve. Now, ironically, they didn't have to buy a lot of bonds to do that because they told everybody, look, it doesn't matter. We're going to buy as many as we need to buy to make these rates where they are, and you can bet we'll do it. And when you make that kind of statement, well, people don't challenge you. And they really didn't. And if you look at that agreement between the Fed and the Treasury lasted for a long time. And coming in the 40s, coming out of the World War II, 45, 46, 47, and into the 50s, we had some years with some pretty high inflation rates and interest rates didn't go up. Well, they didn't go up because people knew if they tried to push rates higher, the Fed was going to buy those bonds. And by the way, I think that is the essential mistake of quantitative easing in this era. The essential mistake is that they did not give a rate level and say, we'll defend this level. They just said, we're going to buy a bunch of bonds. And I think that was a mistake. I think they could have bought a lot less bonds and accomplished the same thing by doing what they did in the 40s and 50s. Look, quantitative easing is a swap of an asset for a bank. The Fed is out there buying these bonds. They're buying them from the primary dealers. The primary dealer sells them a bond. They get a bank reserve in its place. And now bank reserves the Fed pays interest on bank reserves. So they sit there and they park it at the Fed and they get paid on the reserve. But there are some limitations with what they can do with those reserves. They can't lend them out. They can't use them as collateral and so forth. So in some ways it ties the bank's hands. There's a whole argument out there about whether the Fed should be paying interest on reserves at all. There are some people that believe that when they instituted that policy in August of 2008, that's what caused all the problems in the fall of 2008. I don't know if I go that far. The bottom line is that quantitative easing did make it easier for banks and brokerage firms to trade, and trade they did. It was a loosening of liquidity at the trading level. It was not necessarily a loosening of liquidity or a easing of liquidity in the economy. So it's very interesting to me. If you go back and look at Bernanke's op-ed in the New York Times when they instituted quantitative easing the first time, he basically told you, he said, look, we want people to take risk. We want people, this will push people out on the risk scale. They'll do riskier things. It'll be good for the economy. And the problem with what he said is that he didn't specify the type of risk that he wanted people to take. And what we didn't want was people to speculate in the stock market. That's not the kind of risk he wanted. He wanted people to take risk in the real economy. He wanted people to borrow money and start businesses and do things like that. And that's not what happened. I find it very interesting. He called it what was it called? The asset channel or something like that. The asset price channel or something bottom line is this. It did not work. The Fed got a bunch of speculation in the stock market. They did not get any risk taking in the economy. And we've been living with that we lived with it for 10 years, 12 years, whatever. I mean, yeah, quantitative easing ended at some point in the 2015, whatever it was, but it came back after COVID. It doesn't do what the Fed wants it to do, which is to create that risk taking in the economy. It does create risk taking in markets, though. So, it is what it is. Look, quantitative tightening, everybody's worried about that right now. I've said this many, many times. I'll say it one more time. Don't waste your time worrying about things that everybody else is worried about because it's already in the market.
Sure.
I don't have any reason to worry about quantitative tightening.
And with QE, the story that kind of went out there when the Fed initially announced it was this is something new. It's just a bunch of money printing. It's going to cause massive inflation. If we look at history and we look at what's happened, that's not really kind of an accurate description of what happened or what's going on, correct?
Well, no, it's not at all. In fact, look, again, I'm not a monetary expert, and I don't really think most of this stuff it doesn't matter as much as people think it does. It matters to the psychology of the market, I suppose, but it's just not something I think you need to spend a lot of time on. But let's think about this. We had quantitative easing after 2008, right? So during 2008 and after 2008, it ran for I don't know how many years. Doesn't matter. QE 3, 4, 5. I don't know. Count them. I don't care. There was a bunch of them, and they bought a whole bunch of bonds that bloated the balance sheet, and then they tried to shrink it, and that didn't go so well, so they stopped and whatever. So why did we not get inflation after 2000 and 2009, but we did get inflation after COVID? And I think a lot of people want to point at the monetary part of that and say, here's why. And I think it's a lot more complicated than that. Put it this way, people have this one explanation for everything. I just can't buy that. The economy is much more complicated, but the basics, I think there was a monetary element to the inflation that happened after COVID that didn't exist in the 2009. And the difference was fiscal policy. Look, we did see a big rise in the monetary aggregates, M2, M1, after COVID's version of QE. Why? Well, because we handed people a whole bunch of money. It's not that complicated. In the previous iteration, that money never got out in the economy. It may have gotten into markets in some sense, but it didn't get out in the real economy. So, look, look, these things are very, very hard to figure out. And here's I'm going to let you in a little secret. You don't need to figure them out. I don't know what the exact mechanism is for quantitative easing, quantitative tightening, but I do know what happens in the market, and the market tells you what's going on. And all you have to do is watch the market and watch the economic stats as they come in, and you respond. People have this idea that they got to predict the future in order to be a good investor, and you just don't have to. What you have to do is be able to respond to what's going on right now, and that doesn't require you to know how monetary policy works.
Yeah, and I would just on that, although people focused on monetary, I mean, some of the things you had going on a regulatory basis, you had shutting down parts of the economy, and we're still seeing shutdowns in China, basically really dampening supply and affecting supply chains. And we're probably still seeing a move away from China that's going to have a long-term impact on supply chains. You mentioned fiscal policy. I mean, sending people directly checks in the mail. You can talk about velocity of money, but it seems when you actually hand people cash, especially in lower income groups, they're going to spend it a lot more dependably than maybe doing something with bank reserves. But that really, we've kind of seen regulatory fiscal policy have an impact in a way that people sometimes imagine monetary policy was going to.
Yeah. Well, also after 2008, you had Dodd-Frank and all these other regulations come in that had an impact too. And I can't tell you exactly how all those things affected the banking system. You can't do it. I think it's interesting too, the lending factor. Quantitative easing, they had this idea that they were going to hand these banks all these reserves and they would lend money. And it didn't happen. And it didn't happen, frankly, I think, because they were making money trading. Banks are going to do what's most profitable. And QE allowed them, the liquidity it provided them, allowed them to trade and be very profitable at trading. So that's the thing they did. What's interesting to me is that right now we've stopped QE, we started doing quantitative tightening, and actually 6 months prior to that, you started to see loans rise. And I think, listen, again, I'm not a monetary expert, but I am a study. I do study people, and I think people and the way they conduct their business is always the same. They're always going to look to maximize profits. So what do the banks do? The banks know that kind of the gravy train on sitting there and making a risk-free return on reserves is going to go away. So what do? Well, Well, they went to the next thing. They said, well, we got to do something to make money. So they started lending. You look at C&I loans right now. You look at consumer loans. Even in real estate, everybody's talking about how terrible real estate is. I got news for you. Banks are increasing real estate lending. It's still going up at pretty big rates, by the way. So quantitative tightening in its own way actually may be the thing that causes more lending, that causes money supply. It may be that quantitative tightening is the thing that's inflationary. And I know that's a very, very controversial thing to say, and I quite frankly don't care. I don't know if it's exactly true or not, but it seems that that's what's going on. I can tell you this: if banks are lending a bunch of money, and they are, that's not deflationary. So we're going to see where this goes. We are kind of the opinion here that inflation is going to be a little stickier than people think. I do think that it's going to come down rapidly because you've seen a lot of the things that driven up last year from the war and all these other things. That stuff's deflated. It's come back down. That's the commodity piece. But I don't know. I don't think the economy is nearly as bad as people think it is. And look, this is the other thing too, the C&I loans, and somebody said this to me not long ago. Oh, well, that maybe companies are borrowing as a precaution, because we've seen that before prior to recession. I don't think that's what this is. I don't think companies are doing that. They don't need to. They're already flush with cash. So I don't know if I buy that argument, but I get it. I understand that's a possibility. But like I said, I just think that really quantitative easing, quantitative tightening, anything monetary, if you really think you know what's going on, yeah, you're probably wrong. I don't think there's very, very few people that know exactly how all this stuff works. And even those people, there's no way they can connect all those dots and all those moving parts and say, this is what the outcome is. I don't think there's any way to do it.
No, and I think one thing most of the quote unquote monetary experts have gotten is they've gotten it wrong. I mean, whether they were in the camp of this is going to be incredibly inflationary, or whether they were in the Fed's camp of this is going to encourage the kind of risk taking that drives higher GDP growth. Well, we had anything but that after it. It really seems kind of more the tack you've been taking of let's actually look at the results. Let's actually look at how the market responds to what's going on, and then base our analysis on that. And what you're kind of saying is when QE was happening, based on what was happening in the markets, we had more of a disinflationary view, and QT we think is going to be kind of more inflationary, but a lot of it's going to be on the margin. It's more important actually maybe to check the fiscal, the regulatory, the geopolitical, and we're going to get to a later conversation, but also the demographics and some of ththose things really have a conversation about inflation. But maybe don't pay so much attention to the monetary stuff that everybody else thinks they've figured out.
Again, just watch the market. Look, what I can tell you right now is that I can tell you this for a fact. Nominal growth expectations are rising. Period. End of story. I know that. Why do I know that? Because the 10-year Treasury note yield is rising. And the correlation between those two is very strong. Okay. So nominal growth expectations are rising. What does that mean? Well, we don't know exactly what it means because part of that is inflation and part of that is real growth. So what's the breakdown? How much is real growth? How much is inflation? Well, obviously the market believes and has believed for a while that a big chunk of it is going to be inflation. And that's been true. Look at the GDP numbers. Look, nominal GDP is going up at 10%, and you're getting a real growth rate of 1%, whatever the numbers are. I mean, I'm making those up; those aren't exact, but you get my point. A big chunk of GDP growth is nominal; it's inflation, but we don't know that that's going to stay that way. I would point out, and if you look at real rates, tips rates have gone up. That's a positive sign for real growth. Real interest rates. I don't think people don't pay enough attention to this. Real interest rates are so much more important than nominal rates. Nominal rates, yeah, they give you an idea about things, but the bottom line is you can watch the market and get a lot of information. So what do real rates mean? If real rates are positive and rising, what does that mean? Is that good or bad? I think there's a lot of people that would go, well, that's not so good. It means that, oh, those rates are rising, valuations got to fall or whatever. But I'm not talking about how it might affect the stock market. What does it mean to the economy? Well, real rates, I was taught many, many years ago, real rates is the intersection of savings and investment. And if real rates are rising, it means that the demand for capital, for investment, is rising relative to the supply of savings. Well, here's something I can tell you. We got a boatload of savings right now because everybody during COVID got paid. So we got a boatload of savings right now. And there's obviously this demand for capital to invest. And we know that because real rates are going up. That's not that complicated. Now, look, there's a whole bunch of other theories about why real rates move. I am a real simple guy. I'm a supply and demand guy. And supply and demand is really simple. It's about investment demand and the supply of savings. And if real rates are going up, it means that that demand is there for that investment. That's good news. I got news for you. Economic growth is about investment, because economic growth is about productivity, and productivity is about investment. So, I see rates going up. I think that's a good thing. I would prefer that it was with lower inflation, and I think we'll get there eventually. But again, you don't need to know how the monetary system works to know that nominal GDP expectations and you can, again, there's ways to look in the market. What are happening to inflation expectations? We know what those things are doing because the market tells us exactly what they're doing. And look, it's kind of a wisdom of crowds thing, right? We got millions and millions of people trading and investing in these things, and it gives you a result that's probably going to be pretty close to reality. The market's not always right. In fact, at times it can be spectacularly wrong, but most of the time it's going to be right.